Our next speaker is someone who has a keen insight into how some of the macroeconomic drivers could affect Australia, and indeed that target of 100 billion. Stephen Halmarick is Managing Director, Head of Global Market Research at the Commonwealth Bank, and will bring us an inside look at what may happen next in global economies. Stephen, my only fear is it's just been so quiet on the markets, I don't know if we're going to have anything to talk about. Please make him welcome.
Yes, thank you for that kind introduction. As the way with economists, I sent my slide pack down last week and it's out of date as this morning. So what I'm going to do is go through some of the slides quite quickly, but really try and update our thinking on what's happening in the global economy and markets and what the central banks might do about that. The first thing to say is the Commonwealth Bank's absolutely delighted to be invited to this event today. It's a real pleasure to be speaking to you. Supporting the agricultural sector is a key pillar for Commonwealth Bank, and we're certainly focused on that now and into the future. I think the target of the 100 billion by 2030 is a really great target. The agricultural sector obviously plays a very important part of the Australian economy, so it'll be great to see the continued development of that. We're particularly interested in looking at the pillars. Pillar 5 around capital and risk management is something we at the Commonwealth Bank are very much focused on and think we can help. Let me just get to the slides. Hopefully this is going to work. So the first thing to say about the global economy is that the pace of growth was slowing last year anyway. Things like the US-China trade conflict, the Brexit, big slowdown in India as well as China had seen global growth slow in 2019 to its lowest pace since the GFC. And that was true of our major trading partners as well, so a slowdown in growth. Now, the expectations were that 2020 would be a better year for the global economy. This chart here shows the expectation for global growth from the IMF as we go through the year, and you can see that 2019, the red line, the year ended up being a lot worse in terms of global growth than expectations at the start of the year. As I mentioned, that was really around the US-China trade war and slowdown in countries like China and India. But the expectation for 2020 was for a pickup in growth. Unfortunately, that picture has now changed, and as of yesterday morning, we revised down our global growth forecasts quite aggressively as a result of the coronavirus and perhaps more importantly the policy response to the coronavirus. So the way to think about the coronavirus is it's a significant supply shock to the global economy. So certainly lots of people will become ill and unfortunately some people will die. But the real issue here is around travel and education. And when I start talking about Australia, we can look at the impact of those two sectors on the Australian economy, but also significantly on the global supply chain. So we saw recently, late on Friday, China released their what's called PMI data, the Performance of Manufacturing Index for the month of February. It dropped very, very sharply from around 50 to about 30. That's the lowest level since the GFC. And that's a really good example of how quick the slowdown has been in places like China as just factories shut down and the supply chain begins to break down. So the forecast for global growth for 2020 was 3.3%. It's now 2.8%. So that means 2020 global growth will be about the same as it was in 2019. We revised our China growth forecast for this year from 6% to 5.5%, and revised down our US growth forecast this year from 1.6% to 1.4%. And as I mentioned, global growth revised from a bit over 3% down to 2.8%. So even before the coronavirus effect arrived, we've been seeing, as I mentioned, this slowdown in global growth. So on the left-hand side here, we have business capital expenditure plans in the US, and you can see that we've been on this downward trend for business capital expenditure plans well before the coronavirus arrived. and we've seen a significant slowdown on the right-hand side of global export volumes and global industrial production. So the global economy was in not a great shape before we had this significant supply shock come and will now impact global growth pretty meaningfully. Now, one thing that markets are now expecting and looking forward to is a response from major central banks. So US equity market was up last night after on Friday the chair of the US Federal Reserve released a very short statement saying although the fundamentals of the US economy were very strong, the coronavirus was going to have a big impact on the economy and that the US Federal Reserve stood ready to respond to that as and when required. And they can do that in a number of ways. They can do that by just providing liquidity into the system, into the banking system to ensure that money continues to flow around. And they can also do that by cutting interest rates. So the expectation now is that the US Federal Reserve will cut interest rates at their next meeting, which is on the 18th of March. As you can see on this slide here, the Fed cut interest rates 3 times last year, and we thought that they would cut interest rates another 2 times this year. But our expectation was that those rate cuts would be late in the year, September and December. We've brought forward that timing to the next meeting, which is on 18th of March, as I mentioned, and then the following meeting, which should be in April. So that's 2.25% rate cuts expected in the next couple of months. There is some risk that they might actually just cut by 50 basis points, by 0.5% at the next meeting, if the markets continue to be as volatile as they've been in recent days. But as I mentioned, just that mere statement from the US Fed chair on Friday seems to have stabilised US markets overnight. So other central banks have much more limited firepower. The European Central Bank's official interest rate is currently minus 0.5%. So if we want to get into a discussion on how negative interest rates work, maybe we can do that on the panel. The official interest rate in Japan is minus 0.1%. And of course in Australia we're at 0.75%. I guess the luck of timing, the Reserve Bank Australia board meets today to decide on interest rates. This time last week, last Monday, the markets had priced in a 7% chance that the Reserve Bank would cut interest rates today. As of the close yesterday, the markets had priced in a 97% chance that the Reserve Bank would cut interest rates today. So you can see how rapidly things have moved in the last week. So there's a high probability that the Reserve Bank cuts interest rates today from 0.75% to 0.5%. We had expected a rate cut in April anyway, and so the coronavirus effect just might bring that forward by a month. If they don't cut interest rates today, then we would certainly expect to see a rate cut in April. In fact, we had already expected a further rate cut, so our base case forecast was 2 rate cuts in Australia this year before the coronavirus effect arrived. So we had expected interest rates to be down to 0.25% later this year. That's now more likely and likely to happen sooner. I do have some charts here on the coronavirus effect, but they seem a bit redundant now because these focus only on China. And I was going to tell you that the spread in China had slowed, and that was really good news. So that still is good news. But the issue now, of course, is that the spread has moved outside of China. South Korea, Italy, Iran, many other places around the world are now seeing big increases in the coronavirus impact. What I will show you here is some charts on China. So the red line is the average level of activity in these different parts of the economy in China, so property sales, traffic, and coal consumption. So the red line is the average between 2016 and 2019 in the days following the Lunar New Year holiday. The blue is this year. So you can see a significantly lower economic activity post the Lunar New Year in property sales, in traffic flow, and in coal consumption in China. So that gives you a good idea of just how significant an impact the coronavirus has had on economic activity in China. So the Chinese authorities will respond. They will cut interest rates. They will provide liquidity into the banking system. They will allow local governments to issue more bonds. Those bonds will be bought by the state-owned banks, and that money will be provided to try and stimulate the Chinese economy. So that chart on the left-hand side there just shows you that PMI index that I mentioned earlier, just how rapid a decline we've seen. So on the right-hand side is our attempt of forecasting the Chinese economy. You can see lots of volatility in that number now, but that's assuming a bounce back in the second and third quarters of this year. But if the coronavirus effect takes longer to go through the economy, that bounce back will be delayed. So certainly looking at slower economic growth in China this year than otherwise would have been the case. As the coronavirus started to go around the globe or impact growth, many people were comparing it to the SARS outbreak in 2003. So the coronavirus is less deadly, but it's spreading quicker. But one of the key points is that in 2003, China accounted for 4% of global trade. Today it counts for 18% of global trade. So the impact is much more significant. So with that all in mind, I'm now going to turn to some discussion about what's happening here in Australia. Now, so this year actually marks the 29th year of consistent growth in the Australian economy. So the last recession was 1991. I'm sure a few of us remember that recession. So we haven't had a recession for 29 years, and I actually think we don't celebrate that enough. That's actually a remarkable achievement. So this is the longest stretch of positive economic growth of any major economy post-World War II. It's a really fantastic achievement. But I think most of us certainly are of the view that growth is quite slow at the moment. We could be doing a lot better. So the pace of economic growth, the most recent numbers we have were for the third quarter last year, is 1.7%. But we actually get the fourth quarter of 2019 GDP numbers today at 11:30, and we expect that to show a small increase in the pace of annual economic growth to 1.9%. So that's not bad, but the long-run average for the Australian economy in terms of annual economic growth is 2.75%. So we're well below that long-run average. Now, usually people get excited about the GDP numbers when they come out. They're a little bit dated, but usually that's something that most economists get pretty excited about. I would imagine today's number will pass by without too much interest at all, because it's all in a rear vision mirror. It's October, November, December 2019. What we're really interested in is what's going to be the effect now of the coronavirus and going forward. So when we get the first quarter of 2020 GDP numbers in another 3 months' time, they're likely to be significantly weaker than the numbers we get today. The other aspect of the Australian economy is the unemployment rate. So it's currently 5.3% as of January. So that's up marginally from the lows we saw last year that were just under 5%. And the final thing is inflation. The Reserve Bank is targeted with keeping inflation between 2 and 3% average over time. We have not hit that 2 to 3% target for roughly 5 years, which is why the Reserve Bank is continually easing monetary policy, lowering interest rates in an effort to generate some more economic activity that raises inflation. Of course, before the coronavirus impact, we had the devastating bushfires of late last year and early this year. Of course, many of those bushfires not far from this part of the country. Certainly down New South Wales, South Coast and into Victoria. If we look at the effect of the bushfires on economic growth, it's quite a poor way of looking at it. The way the statistics are calculated, when a home or a business gets destroyed or is burnt down, that's not measured by the GDP accounts. So no loss of production is measured. When those homes or businesses get rebuilt, that's calculated as a positive to growth. So looking at the economic stats of the bushfires, I think is pretty unsatisfactory. But if we try and isolate that effect, the parts of the country that have been affected by the bushfires account for between about 3.5% of total GDP of the Australian economy, about 3.8% of total employment. we assume about a 10% reduction in activity in those regions, that will reduce growth this year by 0.3%. So even before the coronavirus effect arrived, we were looking at a reduction in economic growth this year of about 0.3% effect of the bushfires. Now for Australia, one of the main channels of impact of the coronavirus will be on education and tourism. So education is now our third largest export, and tourism is our fifth largest export. And of course, both those sectors are dominated by people arriving from China. So particularly in New South Wales and Victoria, the Chinese student numbers are significant. And last year or two, China overtook New Zealand as the number one source of inbound tourists to Australia. And in terms of dollars spent, the Chinese spend more money while they're here than any other tourist group. So the travel ban on Chinese tourists and education will have a significant dent on economic activity, particularly in the tourism and education sectors. So just moving away from those effects, if we look at the economy more broadly, I just want to talk about a couple of themes that have been dominating the Australian economic landscape. One is that the split of income growth in the Australian economy has diverged quite significantly in recent years. And you can see in the blue line on the left-hand side, the wages share of income has been very soft, very modest, so very low increase in wages, whilst the corporate profit share of income has been increasing quite substantially. And as a result of those changes, you've seen the household savings rates and the amount of money people save of their income has been on a steady downward decline for a number of years. You can see on the green line there that spike up in the most recent reading. That was the tax refunds paid in the third quarter of last year. So essentially what happened is the government paid tax refunds and people saved that money, they didn't spend it. And part of the primary mechanism of saving that money was to pay down debt. So with the household heavily indebted, people took the opportunity of that, a little bit of extra money coming in the tax refunds to actually pay down some of their debt rather than go and spend it. We can also see that consumption in the Australian economy is being held up by the public sector, whilst household consumption is very weak. That makes a lot of sense when you've got very limited wages growth, high debt levels in the household sector, very limited extra income to spend in the household sector. So it's been the public sector that's holding up growth. And as I mentioned previously, the Reserve Bank's been missing their inflation target consistently for a number of years. The export sector of the Australian economy has certainly been a bright spot. As you can see here, resource exports have been incredibly strong. So we can have iron ore prices up until recently had been quite high. Coal exports, particularly also the LNG exports now coming online. Huge developments off the coast of Western Australia and Northern Territory, increasing our exports of resource quite significantly. You can see rural in there, the red line has been flatlining or dipping down a bit. That's clearly the impact of the drought on the rural sector. But again, the green line there, services, that's tourism and education, have been increasing quite substantially. And as we just talked about, they will be hit by the coronavirus. But one thing that we've seen in the Australian economy in the last year was the move to a current account surplus. So this is the first current account surplus in Australia since 1975. So a really significant turnaround in our net export position. So without the export sector, the Australian economy would have been significantly weaker over the last 2 or 3 years. So the export sector has been definitely one of the key drivers of economic growth for the last few years. And we can see there our prices had been pretty high, particularly driven by iron ore. And of course, we all know that our export destinations dominated by China and also Japan. So these Asian regions are significant markets for us in terms of exports. One of the other sectors that's been really driving economic growth, and particularly again in the public sector, is infrastructure spending. So huge increase in, particularly around Sydney and Melbourne, in some very large infrastructure projects. Also, I know some down here in Canberra as well. And as you can see from this chart, we've still got a long way to go on these major infrastructure projects. And with borrowing costs so low now for governments, this is really a fantastic time for governments to be borrowing money and investing in significant infrastructure projects. They help growth today, they create jobs, but they also help growth in the future by really improving productivity and just the ability to move people and services around the economy. The labour force has been really interesting. The unemployment rate has moved up a little bit, but we've also seen a really big increase in the participation rate, so people entering the labour force, and that's been dominated by more and more female labour force participation, and also older Australians, those aged 16 plus, are really coming back into the labour market. So the unemployment rate, 5.3%, but we've got this underemployment rate that's hanging around 8.5%, almost 9%. And the Reserve Bank recently changed their estimates of how low they think they can get the unemployment rate before we generate inflation. Previously, they thought 5% was the low we could get to on the unemployment rate. Now they're saying we should aim for 4.5% before we could generate any inflation. That's another reason why we expect interest rates to continue to come down. Now, at the Commonwealth Bank, we're very lucky in that we have a huge source of data and information on the Australian economy. At any one point in time, up to 40% of every financial transaction that happens in Australia flows through the Commonwealth Bank. So that gives us a really good understanding of the level of spending in the economy. So that's happening now. But what we were thinking in the research department is we really want to understand not just what's happening now with spending, but what is going to happen in the future. So what we've done is we developed this series called the Household Spending Intention Series. And the way we measure intentions is we look at what do people search for on Google. So in this day and age, if someone's going to spend money, usually before they spend money, they go and search online. So we found this way of marrying our actual transactions data with Google search data to give us a look into the future on what people are spending money on. And we've created 7 different categories of spending. So I'm just going to quickly run through what that data is telling us about the Australian economy. So number 1 is telling us that the housing market is recovering very, very strongly. So the left-hand side there, the home buying index, up very, very strongly. In fact, it's back up to almost record highs, and we're seeing prices in Sydney and Melbourne move higher again. Conversely, look at retail sales, really just kind of like bouncing along the bottom. And these are the 2 sectors most impacted by the bushfires and the coronavirus, travel and education. So remembering this is data up until January, and you can see a big impact in the January numbers. We get the February numbers in a few weeks' time, and I would imagine we're going to see quite a significant downturn in both those. But as early as January, we're already seeing both the travel and the education sectors come away quite quickly. The other sectors we look at, health and fitness, entertainment and motor vehicles. So the health and fitness number jumped quite strongly in January. I'm willing to bet that's people making New Year's resolutions and joining a gym. But I have to tell you, you actually have to go to the gym to actually make it have any impact rather than just sign up. So that's a little bit disappointing. But maybe every January we see a spike, and then by the time we get to March, people have kind of forgotten about that. You can see entertainment was improving, and motor vehicles is really interesting. Motor vehicle sales were very, very weak, but they now look like they are improving, and that usually follows on in improvements in house prices. So apart from a house, usually a car is the second largest expenditure for a household, so we are seeing an improvement in car sales. So it'll be interesting to see how that holds up post the bushfire coronavirus effect. So just on houses, as I said, we're seeing prices move up quite rapidly. We would expect to see house construction begin to improve in the second half of this year. So that should be a support to economic growth and improvement in residential construction. If we look at on the right-hand side here, you can see household net wealth is actually improving again. So as house prices begin to rise and interest rate costs come down, that is improving the net wealth position of Australian households. So as I mentioned, interest rates fell 3 times last year. Prior to the bushfires effect, prior to the coronavirus effect, we were already expecting 2 rate cuts in Australia this year. They're now likely to be brought forward. As I mentioned, one of those could be today. So we could easily be down at a 0.5% interest rate today and down at 0.25% in the not too distant future. Now, the Reserve Bank Governor has made it clear that 0.25% is the lowest he would cut the official interest rate to, what we call the effective lower bound. He doesn't want to go to 0. He doesn't want to go negative. So the big question is, once you get to 0.25% and you still think you need to ease monetary policy, what do you do? And the example in other countries around the world is this policy known as quantitative easing. If we do have time, we can talk about this on the panel. So that's essentially the Reserve Bank buying government bonds to force down the interest rate for all those bonds, so force down the risk-free interest rate in the economy, and that would then force down interest rates further along the maturity spectrum for other borrowers as well. It would be quite a radical development for Australia to join that quantitative easing policy path, but many other economies have done that, the US, Japan, Europe, the UK, and with now the impact of the bushfires and the coronavirus coming over to hit the Australian economy, the risk of us moving into quantitative easing has risen quite significantly. So I'll leave it at that. Thank you for your time. I hope you enjoy the rest of the conference. Thank you.